On April 2nd, 2025, President Donald Trump declared it Liberation Day for American trade, launching a massive wave of reciprocal tariffs on nearly all major trading partners. The base tariff was raised to 10%, a big jump from the earlier average of just 2.5%. And for some countries like China, the European Union, Vietnam, and even India, the tariffs were much higher. Even countries that the US has trade surplus with, like UK, Brazil, and Singapore, weren't spared. In this video, we are going to break it all down. We'll explain the various dimensions associated with this. Let's start with the why. Why is the US doing all this? White House stated 4 objectives while imposing the tariffs. At first, US is facing a massive trade deficit of $1.2 trillion. Second, in recent times, US has been witnessing major dumping of cheap Chinese products, endangering their domestic markets. Third, by imposing reciprocal tariffs, Trump administration plans to boost its revenue exchequer for facilitating tax cuts as promised during his election campaign. Fourth, the US said it was about national security. For example, some of these tariffs are aimed at countries like Mexico and China, which the US accuses of letting large amounts of fentanyl, a deadly drug, entering the US illegally, and not doing enough to stop illegal migration across the southern border. So the idea is, if those countries don't act, the US will hit them with tariffs to pressure them into taking action. But before we delve further, let's understand the basics. What are tariffs? Tariffs are simply taxes on goods that come from other countries. Let's say India sells t-shirts to the US and the cost of t-shirt is $10. If the US puts a 20% tariff on it, now it will cost $12 for the American buyer. That extra cost makes local US-made t-shirts more competitive, which means it will rather be cheaper to buy US t-shirts than Indian t-shirts. So tariffs help protect local industries, raise money for the government, and sometimes punish other countries for unfair trade. What is a trade deficit then? Trade deficit is the difference between the value of goods exported by any country and the value of goods imported by that country. The US has a trade deficit of $1.2 trillion. That just means every year the US buys 1.2 trillion more goods from other countries than it sells to them. A trade deficit shown with a minus sign of more than $1 trillion means the US imports $1 trillion worth more of goods than it exports. A deficit isn't always a disaster, but over time, it can lead to loss of jobs and weaker local industries. So that's one of the main reasons Trump's team says they're doing this. Following the US tariff announcement, China responded with its own tariffs, leading to a tit-for-tat escalation. European Union expressed intent to challenge the tariffs at the World Trade Organization and considered retaliatory measures, whereas Japan opted for diplomatic negotiations to seek exemptions, and India chose a cautious approach, stating it was studying the implications of the tariffs. The series of actions and reactions has led to what's now termed a trade war, characterized by increasing tariffs and strained international relations. The ripple effects of the tariff war are being felt worldwide. First, slower global growth. Tariffs disrupt supply chains, leading to decreased economic activity. Here's how. Most products today aren't made in one country. They are built in steps across many countries. Take a smartphone, for example. The screen might come from South Korea, the chips are from Taiwan, it's assembled in Vietnam and then sold in the US. This is called a global supply chain. Now imagine the US puts a big tariff on chips from Taiwan. Suddenly, the cost of making that phone shoots up, even though the final product is assembled somewhere else. Companies then have to rethink their suppliers, move factories, or raise prices. And this ripple spreads across multiple industries, from electronics and cars to clothes and medicines. In short, tariffs don't just hit one country, they shake the whole web of how the world does business. Second, market volatility. Stock markets have reacted negatively, with significant drops observed globally. For instance, in Asia, Japan's Nikkei dropped by 2.3% and Hong Kong's Hang Seng fell nearly 3%. a sign that markets fear this trade war could hurt profits and growth everywhere. Third, potential for stagflation. A combination of stagnant growth and high inflation looms as a risk. India, facing 26% tariff on its exports to the US, sees varied impacts across sectors. Shrimp industry, which is valued at $7 billion, is under threat as US buyers will reconsider their orders, affecting thousands of farmers in Andhra Pradesh. India saw a surge in exports ahead of the tariff implementation, with Apple iPhones playing a significant role. In pharmaceutical sector, India saw a relief as this sector has been exempted from the new tariffs, safeguarding a significant portion of India's exports. Well, while tariffs are hurting some industries, there is also an opportunity. As global companies look to move out of countries like China to avoid high tariffs, India becomes an attractive option. Why? Because India has a large and young workforce, a growing tech and manufacturing base, and most importantly, a reputation as a trusted, stable, and business-friendly country. That means big global brands, whether they make phones, electronics, or clothes, might set up factories in India instead. And it is already happening. Apple has started making newer iPhone models in India through Foxconn and plans to shift more of its production here. Samsung opened one of its world's largest phone factories in Noida. Other companies like Lava, Dixon, and Pegatron are expanding too. This could lead to more jobs, more investment, and a stronger role for India in global trade. So while the trade war brings risk, it could also open new doors for India on the world stage. Additionally, India's strategy of restraint and ongoing negotiations for a bilateral trade agreement with the US may offer a pathway to mitigate these challenges. The US has paused most of the new tariffs for 90 days, sparing countries like India, the European Union, and Brazil. However, China remained an exception, facing tariffs that escalated to 145%. So what prompted this sudden change? The immediate trigger was a sharp sell-off in US government bonds. Foreign investors, particularly from Japan and China, began dumping US debt, leading to a spike in bond yields. This surge signaled a loss of confidence in the US economy. So what's the bigger picture here? President Trump's tariff war isn't just about trade. It's part of a much larger shift towards something called protectionism, where countries try to protect their local industries by keeping foreign goods out. But this isn't the first time the US has tried this. Back in the 1930s, during the Great Depression, the US passed the Smoot-Hawley Act, which raised import tariffs sharply to protect American farmers and businesses. Sounds familiar? Instead of saving the economy, it actually made things worse. Other countries hit back with their own tariffs, global trade collapsed, and the economic crisis deepened and lasted for years. Today, many experts are worried that we might be repeating the same mistake, just on a much larger global scale.